All right, to be respectful of everyone's time, we want to go ahead and get ourselves started. And I am being joined today by two absolute superstars in the opportunity zone space. Michael Krueger over at Lucosky Brookman, partner attorney, and also, if I am correct, head of the opportunity zone special practice group there at the firm. Welcome.
Right. Thank you.
Yeah, you bet. And then we also have Todd Vitzthum from ACARA Management, managing partner there, and also real estate expert in the opportunity zone space. And I know you've really made a name for yourself in this space, Todd. Good to have you today.
Good to see you, Jeff. Thanks for having me.
You bet. And so the intent of today's call, everyone, is to be able to have an open discourse with folks who are experts in this space. We obviously have what I believe is the optimal hybrid here. We have legal opinion. We have a gentleman who has decades of real estate experience and development experience, and now also in the opportunity zone space experience. And so to be able to bring that all together, I think in what is a single call is pretty extraordinary. I'll kind of start off with something high level just to start the conversation, I guess, and get everyone's juices flowing. Michael, I know you've been dealing a lot with folks who are building very large projects, who are operating intensively in this space. What are you seeing right now that maybe is different than what it was even 6 months ago or a year ago? How are things changing in the landscape?
I don't know if the existing projects are necessarily changing. I think what we're seeing is a ramp up and a different way to finance it, kind of creative. And what I mean by that is, let's say you've got $100 million project and you only raised 5 mil of that. They're deploying the 5 mil in cap gains already through the QOFs and they're getting, pre-development or whatever they need done there. But then they're working with future cap gains or structuring debt with future cap gain dollars that are then going to utilize the 2027 change on the new fund structure. And I think we're going to see a lot of that this year. I know Baker Tilly is working on a couple structures for that. I know a couple of other funds are doing the similar structure. So I think what we're going to see is very creative financing ways to allow the investors to take advantage of kind of the 10% or 30% stepped up basis starting in January 1st in the 5-year kick out. The other thing that we're seeing are there's a lot more scrutiny now. Institutional investors are coming in, they're kicking the tires on a lot of things. And a lot of the QZBs can't answer some of the hard questions, and they're either getting passed on investment or their existing client base are asking those questions, and it's becoming a little uncomfortable for them. So, for example, there's a Florida project that just came in today, actually. One of my other partners was working on it, and it was Florida developers. They told everybody that it was an opportunity zone deal. Everyone said, great, we're investing in an opportunity zone deal. Not a single person set up a QOF. Not a single person invested through a QOF. They just thought, since it was in an opportunity zone, that they would get the opportunity zone treatment. And you would be shocked at how often that we're seeing that happen now. So it's going to be an issue.
It's really interesting. There's a lot of moving parts, and I think people overestimate how much they're going to be able to kind of do it yourself. I always say it's if you're going to do it yourself, maybe, change a sink in your bathroom. Don't 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 start monkeying with a major tax strategy. Todd Vitzthum, what about you? I know that, there's a lot, like I said, there's a lot changing. It looks like we may have a question already coming in, but before we get to that, just going to give me maybe 60 seconds of optics on how's the ball moving and where do you see that headed?
Well, the first thing I would say, Jeff, is I completely agree with you. It's changed and it's changed dramatically in the past year. Obviously, the impetus of that was opportunity zones were something that was part of the 2017 Jobs Act. Now it's permanent under the Big Beautiful Bill. So, in my side of the world, which has spent daily interacting with developers across the country, what was kind of an afterthought with opportunity zones, my clients have a pipeline of business of call it 10 deals, and inevitably one of them is in an opportunity zone. And they really didn't embrace the strategy of how to create unique structures around opportunity zones. Now, moving forward, everyone is trying to figure out how to put a page in the playbook around opportunity zones. Everyone who is a developer now recognizes that this has the potential to be a big part of their business model moving forward. And really, what it is at the end of the day is a new and I think better business model for people who have traditionally been in the merchant build space, building and exiting based on the institutional equity partner. This gives you the ability to build and hold for 10 years and maintain a GP position and source that investment capital directly from high net worth investors and large cap gain clients. So that's the biggest change on the development side of things, is people now see this as not something that kind of fits into their business model, but a new platform within their structure and how to do this as a build and hold strategy.
I love that. It's really exciting. I'm curious, Michael, maybe back to you, and then we have our first question here in just a moment. Are you seeing more investments right now in real estate or operating businesses? I know this is a question that shows up and it's a bit nuanced.
Yeah, I mean, Todd's seeing a lot of stuff in the commercial real estate space, obviously. I think a lot of people gravitate towards that, but my background is really more on the security side of everything. And even though this is a real estate development deal, it's still not a real estate deal in the eyes of the SEC or IRS. It's a securities deal. But what I am seeing, and it actually wasn't, I think, because of the big beautiful bill. I think it was because that was creating maybe more education, a more educated investor base that was doing that.
While we're kind of resetting on the technology piece of the house, what we'll do is we'll move on to our first question. So, Todd, we're going to direct this one to you. We have Richard, one of the guests, says, I have a very large project in Georgia that a consultant told us was potentially qualified as an OZ. How do we get that process confirmed? And then how do we get started?
Good question. I mean, really, the qualification for an opportunity zone project is it needs to be in a designated opportunity zone, right? And that is relatively black or white. So whether it's an operating business or a real estate project, look at a map. There are several resources. We have an interactive map on one of our websites. You can go to any number, just Google it, and you can find an interactive opportunity zone. But if it's in an opportunity zone, it is a qualified opportunity zone project. And then you go down the rabbit hole of there's a lot of nuance to how you structure that. How long have you owned it? How much can you contribute to a joint venture? Are you going to build it? Are you going to sponsor it? Are you going to be the QOZB and or the QOZF? So there's a lot of what ifs after that, but look at a map. And if it's in an opportunity zone, then you can structure this as a QOZB.
I would also recommend there are a lot of folks out there in the industry. Some are amazing, some are newer. I don't know how to put that. And so I think it's worthy of seeking out some consultation or advice. It's to our last point, don't do it yourself. And so, reach out, talk to someone like Todd. I think that would be terrific, or Michael, and have those conversations so that you understand what the appropriate next steps are. There's a lot of having to go in and fix projects down the road because early mistakes were made, and some things are fixable and then some things sadly are just not. And so what would you say is your guidance? Is it ever too early to kind of be thoughtful about what's coming down the road?
Well, I think you're right, Jeff, and you're polite in saying that the service industry is slowly coming on board with opportunity zones. But one of the things I see is, anecdotally, opportunity zones are not. It's not a legal practice. It's not a tax practice. It's not a real estate practice. It's not a technology. It's all of the above, right? It's a puzzle that you need to put together. And if you're getting advice or guidance from any one of those single service sectors, they're giving it from their vantage point, right? And opportunity zones are still a relatively young science. I mean, nobody went to college for opportunity zones. The service industry is still largely figuring this out. And all in all, they're doing a much better job. But there are a lot of pieces that are seen from kind of a restricted vantage point initially that we're looking at now and having to kind of rebuild, right? Compliance, especially compliance moving forward under Opportunity Zones 2.0, is becoming a lot more, I don't want to say complicated, but there's a lot more to it. So you've got to get that piece of it right. And then from a tax strategy standpoint, from a legal strategy standpoint, you've got to get the framework for opportunity zones down. And the service industry is getting better and better at that. One of the things we're trying to do is build that team so that you don't have to. So that when you step into our business model, the right legal team is there, the right tax team is there, the right real estate team is there. And we can, it's an a la carte menu. We can help you with what you need, but everybody on our team knows about how opportunity zones work.
Yeah, it's terrific. And I I'm very much in agreement. We've talked about this before, but I'm very much in agreement that there is an emerging kind of service component in the field, some of which are amazing. Folks that we would have on this call, I believe, fall into that category, and some of which, kind of got their OZzie certification in a van down by the river, kind of a thing. And so, it's comes in all shapes and sizes. So, I would say, Richard, the short answer I think you've gotten here, which is so long as you can confirm the GIS, the survey data, to be sure that you actually fall within one of those zones. We have a 1.0 finder on ozzlistings.com. So you can just head over there and actually type in whether you have an address or geo-targeting data, then you could utilize that to figure it out. Otherwise, you could always just reach out to an expert. Remember that the locations for OZzie 2.0 are going to shift dynamically. There's a number of reasons for that, but it would be advisable to confirm, especially if the intent is to start pulling equity capital into that project, let's say second half of this year and onward, then you would want to be sure that you're good for both. Todd, tell me a little bit, as things have been shifting, there's all of this conversation and discourse over OZzie 2.0. And how big of a deal is this, or is it just kind of the soup of the day and it's more OZzie just moving forward? Because I see there's a lot of news, especially in the niche part of this industry, and yet is it that big of a deal? How much do we need to be tracking this? And to what extent is this impacting how projects will progress moving forward?
Mm-hmm. Well, I'm very excited for OZzie 2.0. When we were transitioning from 1.0 to 2.0 and the big, beautiful bill was going from the House to the Senate, we were a part of a lot of conversations around what was being proposed and what was going to be implemented. And obviously, the one piece everybody was excited about, because in the age of instant gratification, this 5-year rolling deferral is incredible. Unfortunately, we didn't get that under the big, beautiful bill, but it gives us a little bit of time to prepare for 2027, when I anticipate an entire new wave of capital is going to be pouring into the opportunity zone space. It's given us kind of a year to prepare. We're talking to a lot of developers across the country who are using this year to get ready for OZzie 2.0, because it's a real and permanent thing now, and everybody should be participating in the opportunity zone space. Capital will be there if you are positioned correctly and your project is out there and you're giving it exposure to people who are going to be having these capital gains events. You're going to be in the right place at the right time. Everything else related to OZzie 1.0 and 2.0, and I know there's been a lot of discussion around this, I think it's a little bit overhyped. All the major benefits still exist, and everything kind of gets better. The stepped up basis of rural opportunity zones is something we're super excited about. Keep in mind that a lot of the questions that we get are related to the sunset of 1.0. There's a 2-year overlap in the maps. So everything in an opportunity zone 1.0, and this could go for you too, Richard, your project in Georgia, if, for example, you're not in a designated opportunity zone in 2.0, you still have 2 years to execute on that project and grandfather it in moving forward. So my takeaway is OZzie 1.0 was kind of the learning curve. OZzie 2.0, it gets very real and a lot more real money shows up. So it's time to start getting in the opportunity zone business at some level.
Yeah, that's terrific. Michael, welcome back. I see that we've got you dialed in. It looks like maybe there was internet coverage challenge, but it's good to have you back on. The question right now that's been posed is OZzie 2.0. How much different is this, and how do we anticipate an increase in adoption, a decrease? What are we really thinking is going to happen with 2.0?
We're definitely seeing a more interested investor class. I think the investment it's qualified, it's cautioned, meaning that they're not necessarily jumping at it right now because the benefits don't really kick in until January 1st, but they're planning for it. And one of the things that I have seen a larger increase in is really the questions from the investment advisors. They're the ones who I think were left out of OZzie 1.0 and are going to participate much more in OZzie 2.0. And there's a few reasons for that. It has nothing to do with the opportunity zone structure itself. I think it has to do with some of the lax regulations in the advisory world. We were working on some offering documents this morning, and I was explaining to the opposing counsel, I said, well, the 506C regulations, they're so much easier now. He goes, what are you talking about? You still need to have all the tax documents, you still need to verify. I said, no. Last March, the SEC came out and said if the investment is over 200K for an individual or over $1 million for an entity investor, you don't have to have that. You can just rely on self-certification. So I think we're going to see more investors taking advantage of some of these lax regulations that, again, have nothing to do with OZzie 2.0, but are going to benefit under the OZzie 2.0 structure. And I can go down the rabbit hole talking about a lot of the legal terms and tax things that are going to be more beneficial right now. But I think it all comes down to a more educated investor class, as well as lax regulations for those investors coming in.
Let's move to the next question. So there's been a lot of chatter over the last, let's call it 3 to 5, that direct investment, retail investment into alts is going to uptrend, and possibly technology is going to accelerate that process. There's a lot of reasons that this opinion has been battered about, but I think this is something that is interesting as we talk about opportunity zones, because of the fact that this particular niche strategy states that you have to have a capital gain to be able to invest. And so as a result, it maybe changes the dynamics of how those investments play out. Do you think that there will be more of a trend toward the, let's call it individual rather than institutional, family offices, et cetera? Or what are we going to see? Who's going to be investing in these projects, I think, is maybe the question that's being asked here.
Yeah, no, I think there's no doubt about it. And there's an educational process that's taking place in the industry right now amongst high net worth investors, family offices, service providers in the industry. And, one of the greatest things about opportunity zones, Jeff, is it gives investors the ability to go direct to sponsors. The institutional conduit doesn't necessarily play well in the OZ space. First of all, institutional equity is IRR driven. That's why funds are built for 5 or 7 years. They need that exit to get that disposition profit pop to hit that IRR. Opportunities aren't built that way. Opportunity zone projects are built to hold for 10 years. So it's a perfect fit for people in the family office industry and the high net worth investor side of things, because in my vast experience working with investors, they want to hold real estate long-term for wealth preservation and wealth creation. Opportunity zones is an incredible structure for that. And keep in mind, as long as your project's appreciating in an opportunity zone structure, all of that appreciation is tax-free, and the depreciation you do not recapture. So hold these things, you need to hold it for 10 years to get the benefits. But at that point, be very opportunistic when you look at your disposition strategy, because as long as you're continuing to depreciate, you should hold those assets. And it's such a great alignment. Jeff, we work with a lot of top tier developers across the country. And for a very long time, they've been sourcing equity for their development projects, and they've been largely relegated to the institutional equity structure because that's where the money for development comes from. In addition to this whole new category of business around opportunity zones, investors are becoming a lot more intelligent and educated about how and with whom to invest. And we talk to investors all the time, and they're trying to define the risk profile of a development deal. I always say it's not the project, it's the sponsor. Find a good sponsor that you align with from an integrity standpoint, from a geographical standpoint, from a business strategy standpoint, and invest with that client on a repeat basis. Build and hold and build and hold and build and hold. Those are the type of partnerships that we're very excited about. And I see opportunity zones creating that direct investor portal to these projects and these sponsors.
It's outstanding. Great answer. I'm excited to continue to see this space grow. I do feel, I saw some people that were maybe predictive that this will drop all the way to the level of this like retail investor. You've got 20 million people all putting 35 cents in that they made on Dogecoin yesterday, or something like. I said, well, that's going to be a minute. At the moment, we're certainly seeing that this education process that you mentioned is helping people who are really allocating intelligently, let's say, into top level projects to know how to do that, to be connected with the right people. And certainly that's also part of the mission of OZzie Listings, is to democratize access to those projects. Michael, I'm going to pivot over to you, and slightly different question here, but I'm curious, how are you servicing, let's say, advisors to set up, or in setting up their quaff, and what tools are they using right now? Because I know that's been a bit of a transitional space.
It's an interesting thing because you look at some of the bigger funds that had all of these very, very restrictive rules about, selling out or referring out or whatever they wouldn't allow their advisors to sell anything that wasn't, further analyzed by the custodian or the underwriter, whomever. And I think we're seeing a shift away from those incredibly strict standards. We're seeing much more aggressive, I would say, advisors to explore some of the other markets. And I think it's because of the way people are investing right now anyway. I mean, you could set up your own Fidelity account and have access to quite a few of the same tools and investment opportunities that some of the RIAs have. But I think what I'm seeing is a big difference between an RIA and a wealth manager. I think a wealth planner or a wealth manager is going to have a lot more tools at their disposal to put their investor clients into this. And I think it's a little bit different from the real estate side, because the real estate investors, your best real estate investor is someone who just sold real estate. They like that asset class. But what I think is going to be one of the bigger sources of opportunity zone investors are going to be the employees, the early stage founders of these companies that are seeing exits. Right now, private equity is setting up to have a massive 2026 because the stock market is so volatile. So there's a lot of powder that's been sitting on the sidelines that's going into private equity deals. It's going into roll-ups. It's going into merger acquisition deals. And I think we're going to see a lot of capital that's turned over through the capital gains in that structure. And then the question there is, if you're an advisor and you have a client that has a 10 million capital gain and you didn't tell them about the opportunity zone structure, at least as an option, I don't know if it's going to be at the level of negligence, but you're going to have a lot of answers. You're going to have a lot of angry clients that are asking you questions 10 years from now where they say, wait a minute, I could have put that into an investment deal and paid zero capital gains, or I could have deferred my capital gains for 5 years. So that's where I'm helping these advisors at least answer some of the initial questions, put together their captive QOF to where they can say, sure, you want to do that? You want to participate? Here is a fund structure. You can throw your cap gains in that, and then we can help you. And so me as the attorney and Lucosky Brookman as the law firm, we're able to do that. We'll do the fund structure. We'll set everything in place for them. So now that wealth manager, that RAA, is doing exactly what they would have done for that same investor on their normal investments. They're just setting it up as a separate path, a separate avenue to deploy that capital into the opportunity zones. And they're going to have a much happier client because they're not paying Fed cap gains on that for at least 5 years. And then depending on what they invest in, it's either a 10 or 30% stepped up basis.
Yeah.
There's nobody who thinks they know investments better than the investment client who just gave you their money. They're going to say, look, I think I know what to do. I'm begrudgingly giving you this money for you to manage it for me, but I know I can spend it better than the federal government can.
First off, each of these topics are exciting because we could easily go for an entire call on each of these. And I'm taking some notes here because I'm thinking maybe we should, frankly. I do want to mention to folks who are here and anyone watching this syndicated in case you missed it from OZzie Listings, this is going to be something we're doing on a more regular basis. So as you have questions come up, feel free to come back. You'll be notified about these as they pop up in our ecosystem. And we're excited to bring different panels of experts, et cetera, to answer questions in their unique areas of domain knowledge and expertise. This is really exciting stuff today. Todd, I know that we kind of pivoted a little bit there on the idea of who's investing in these OZ projects. And I was mentioning or kind of hinting at before this idea that's been really tossed around that these retail investors are coming. I don't believe that personally, I'll just mention, I don't believe that they're arriving as quickly into the OZ train station as they might be into different categories of alts simply because of the cap gain hurdle. Let's call it that. That tends to be more aligned with ultra high net worth, family
Yeah.
office, or even institutional. We're seeing some corporate structures moving into the space as a way to really be able to harvest some wins and move things forward. So I want to make sure I didn't cut you off completely. Did you have any final thoughts on that topic? Because I know for folks like who was it here, Richard, he might be thinking in advance. Well, who do I need to be thinking about? How do I target these folks? How do I get in front of the right
Yeah.
people, et cetera? I know you have some real thoughts on that.
Well, I mean, the level of enthusiasm we're seeing for opportunity zones on the investor side is directly proportionate to the size of your capital gain. And exactly to your point, Jeff, this is not a crowdfunding structure. It's not really targeted towards the country club investor who's got $100,000 to invest. What we're seeing are large capital gain clients. And what Michael mentioned, and he's seeing a lot of, when people have a significant capital gain, one of the first things they're going to do starting in 2027, when this 5-year rolling deferral kicks back in, is you're going to see a lot of people form captive opportunity zones funds and then go shopping with those funds. So one of the things we're doing at the QOZB level is we're building QOZBs to accept sidecar. There's no fund-to-fund structure in opportunity zones, but pretty much every qualified opportunity zone business that we are involved with allows sidecar investors. So I think we're going to see a lot more 10, 20, 50, $100 million capital gain clients form a captive QOZF. And then to your credit, Jeff, and what Opportunity Zone listings is, OZ listings is about, and one of the reasons we're so excited to be a part of it is you've opened up a marketplace, a resource center, an educational platform to guide those high net worth investors into opportunity zones and then further into good, high quality curated deal flow, which starts with top tier sponsors. So this isn't, remember in the old days of crowdfunding, you'd go onto the crowdfunding platform and you didn't know the developer and the underwriting looked a little wonky and the IRR was just pick a number out of a hat. And then a whole bunch of people would come in at $10 at a time. And when we unwound that business model, we see that it was not a lot of top tier sponsors, and some of the deals were questionable, right? What we're seeing in the opportunity zone space and the platform that we watch you build is really designed towards top tier clients on both sides of the equation. The top developers in the country are coming onto OZ listings to source capital, and on the investor side, same thing. This is top tier investors coming from large capital gain events, looking to deploy large amounts of capital gains.
You bet. And thanks for the compliment. It's been really exciting and everything takes a great team. There's an incredible team behind what's happening with OZ listings, as you know. And we've looked at all the different options. We thought about trying to do what some other people are doing, try to be the Swiss Army knife and be the everything for everyone, capital stack advisor and marketplace and compliance engine, CRM and ecosystem, hair salon. It's crazy. There's too much there. We just felt like Swiss Army knives are great for camping. In this game, I really prefer to have a blade that cuts. This is what people are actually looking for and what the marketplace needs. So I love that you see that top people in the industry are recognizing that. I think focus wins. Michael, did you have any final guidance or thoughts for folks on here who are contemplating whether that's an investment in or deploying a project, sponsoring an OZ project as we move toward OZ 2.0 here mid-year?
Yeah, I think mid-year we're going to see the capital pick up. We're going to start seeing the cap gain harvesting. I'm already talking to a few people who are looking to do that. But I would say make sure you're ready to accept the investment. Make sure you understand how it's going to be taken down on if you're a QZB developer or business owner. You need to understand how it works and you need to understand the timing. I know we didn't get into a lot of the details on the clocks, but there's 180 days from the cap gain event to put it into a QOF. There's 180 days from the QOF to receive those funds to deploy it to a QZB. And then you have all of the operating requirements of the QZB. So I would say there's less issues on the QOF. That's the easiest thing to set up. Anybody out there who's saying, oh, the QOF fund structure is so complicated, It's really not. The QOZB though is very complicated. And so I would say if you have a business that you're wanting to use on the QOZB structure, you should have an attorney, not just a tax person, but also an attorney review that to make sure your waterfall is correct, to make sure your distributions are correct, and really to make sure your operations are correct. And we can do that for you. That's what our firm does on a lot of QOZBs, but it doesn't have to be a big securities firm to do that. It can be your own attorney that is already on the project, as long as they know what they're doing on that in that space. And as far as the tax professionals, make sure your tax professional really understands the QOZB structure. We work very closely with Baker Tilly. We think they're really good at this. But I'm also advising other CPA firms on their questions. So just because you're a tax advisor or a CPA doesn't mean you really understand this space. So the parting thoughts here are make sure the professionals you hire actually know what they're doing in the space, so you're getting the advice that you're paying for.
Wow, that's terrific. I will obviously, with the replay of this, if it's okay with both of you gentlemen, I'm going to give out your contact information, Michael, so that folks can contact you there with the firm, and Todd there at ACARA. And that way, as folks have questions or follow up for these types of things, they can at least reach out, maybe get steered in the right direction. Did you have any final thoughts, Todd?
I would just say to my clients on the real estate side of the equation, use this year to prepare yourself. Exactly what Michael was saying. If you structure your QOZB correctly, what you're doing is you're preparing yourself for success moving forward when this new wave of capital comes into the business. And there's a lot of things you can do to get yourself ready, to get your projects ready, to get your projects exposure. This year is going to go quick. And a lot of these capital gains that happen after July 1st of this year are going to be eligible for 2.0 contribution into the Qualified Opportunity Zone Fund, given the 180-day deployment window. So it's time to start talking. It's time to start preparing. It's time to start talking with these investors, and you really need to get yourself set up because I see January 1st, 2027 as kind of day one of really how opportunity zones are going to start to work and function. It's going to be a very, very big piece of commercial real estate development moving forward.
Well, there you have it, folks. A lot on opportunity zones. There's a lot of change in the space right now, which is exciting. And so we're going to keep bringing amazing experts to panels like this one so that you can bring questions and make sure that you're staying plugged in at a high level. And as is always our commitment here at OZzie Listings, we want to bring this to you without charging for information that you need to get started. And so thanks again for tuning in. Please head over to OZzielistings.com and check out some of the amazing projects that are there. There are a lot coming, by the way. We have a ton of new stuff onboarding currently in the background, so that's very exciting. And always a good thing just to bookmark that and make sure to circle back around. Michael, Todd, thank you both for being here today. Really appreciate your time and your expertise as always. I learned a lot. Thank you so much.
Thank you, Jeff.
Yes, thanks, Jeff.
Yep. Take care. Have a great day, everyone. Bye-bye.